Greetings, ladies and gentlemen. Today we will talk about how to grow your business with digital payments. In particular, I will tell you about how crypto processing works in details, what benefits you may acquire while implementing that. And I will start with a little bit history. So, 60 years ago happened a great payment revolution. Bank of America, along with other partners, implemented credit cards. That invention basically completely changed the payment landscape and contributed to the modern economy. So before that, all market participants were using cash and checks, and that invention of credit cards, that, it won't be an underestimation if I tell that it completely changed the market. So now we have around 7 main means of payments. We of course have cards. There are a lot of them: credit, debit, prepaid, virtual. For the last 20 years we also acquired mobile digital wallets, Apple Pay, Google Pay, which again shifted the market, and also some mobile payment apps. But now we have a new technology which was implemented like several years ago, and I'm talking about crypto, because I really firmly believe that crypto may change the payment landscape as credit cards done like 60 years ago. So now I will give you a little bit comparison of cryptocurrency payments and card payments, and we'll show you that crypto has certain advantages. So here we have like 3 main points why cryptocurrency is better than card payments. First, chargeback. Second, rolling reserves. And 3, free payout for end users. I'm not talking about that crypto is more secure because, banking technologies are developing quite fast, but in terms of like 10 years, I believe that crypto will hold at least like 20% of all the market. Now, here's some statistics. So, guys from Deloitte conducted a kind of big survey. There was like 2,000 or 3,000 participants, and 40% of all the consumers believe that crypto payments may be implemented. 75% of retailers told that they are planned to start accepting crypto. So it's already happening, and a lot of businesses realizes that crypto can give them not only new customer base, but basically make everything faster, everything more easier. So now let's speak about how crypto processing works from the inside, because unfortunately not many people really understand that. This diagram holds like 3 main points: flow of funds, AML, and process. AML means anti-money laundering. So once you install the system, you can generate any wallet, nominated in fiat currency, in digital currency, for example, Bitcoin or some stable coins. Then what you do? Your client initiates an invoice. A system generates unique wallet address. It cannot be broken. It cannot be somehow, nobody can get into that except yourself and your client. And the user sends payment, and at this moment, Crystal, chain analysis, or some other system conduct like manual check. It's a QAT check. So basically, we analyze the source of funds, whether this crypto is clean or not, and if we understand that crypto is marked as not clean, we will block the payment. After that, we have all the confirmation. Transaction is credited onto your wallet. And then you can use it, you can withdraw that, and basically do everything you want. One main point regarding the merchant model, which is the most popular with crypto processing. all exchanges are done off-chain. What does it mean? If we switch to boring accounting language, so once your customer pays you with crypto, you don't get that crypto on your wallet, but it's somehow like a transfer of title. And your crypto processor holds a liability towards you on the same amount, and then you can withdraw that funds from your crypto processor. Regarding fund withdrawal, it's one of the main concerns of many businesses. So like, okay, if I get the crypto, what will I do next? And how it works. Basically, you create a wallet nominated, let's say, in United States dollars. Your customers pays you with, let's say, USDT. So USDT and dollar is 1-to-1. 1 USDT means that you will get $1. So once you have a wallet nominated in dollars, customer pays you with USDT, and you have denomination of $1 in your $1 in your wallet. Then you can withdraw that funds either to the bank, if the bank is willing to work with a crypto processing company, or to EMI or payment service provider, such as, for example, Equire. So after your funds hit your account, it's basically fiat funds, and well, you can use them as usual. Now, one important topic. Basically, you can accept payments both in major coins and stable coins. And it depends on your risk policy. Like, you can accept Bitcoins, and you can even have some additional revenue from that, like all your costs are nominated in fiat currency, so you accepted Bitcoin, and let's say you hold it. And you understand that, okay, in 2 weeks, Bitcoin will, I don't know, hit like 30,000, and you get additional 200% of profit. Or you may lose. But the thing is always to have a proper risk management in place. Like, for example, you can nominate, let's say, 5% of all your payments in some volatile crypto, and other you can nominate in stable coins. So that's why you always will do like asset liability management. What is stable coins? Here, I will explain you right now. So, the stablecoin is one of the many types of crypto, and basically this is coins which are packed onto some traditional assets. Let's say, I don't know, there's asset-backed bonds. So that means that once I issue the bond, I have some assets which are backed my obligation, like, I don't know, we have mortgage-based bonds, let's say, for the banks. So how it works? I issue $10, 10 USDT, and I put $10 onto the banking account. And for the all time, when I have 10 USDT, the $10 will be lying on the bank account. Of course, I will invest them in some treasuries or, you know, some very less risky assets, but still, the core idea is that all the issued crypto is fully backed with some real assets. It can be gold, it can be dollars, it can be fiat funds, it can be securities, so it depends. And there are like 3 types of stable coins. The first one, as an example, USDC. We call it regulated. Why? Because all the funds are stored in one of the Bank of New York. There is a full audit in place, and you always understand that, you know, like whole issuing of USDC is fully backed with a good assets on the banking account or brokerage account, depends. Then we have unregulated, centralized but unregulated stable coins. Basically, it is USDT. It can be backed with fiat funds, or it can be backed even with some assets, but there's no audit in place, so you never know whether it's really backed or not. So chance of scam, let's say, is a little bit higher. And we have completely decentralized stable coins. And the backend mechanism there can be quite complicated. It may be algorithmic based, you know, it's like pure financial engineering. So From the regulatory point of view, centralized regulated stablecoins, well, you can look on them like on, traditional securities, and they are really fully backed, and it's easier to protect all the customers using them. Second model of crypto processing. Well, it can be called enterprise model. So it works basically the same with a merchant, but the only thing that all the exchanges conducted on chain. So as I mentioned, in merchant model, once you get the payment, it's not within you physically. It belongs to your crypto processor. But here, everything conducted on chain, and all the transactions are conducted through the blockchain. So this model is, well, better for institutional players, and mostly like brokers, exchanges, they're implementing that. And now the last business model, it's basically just create a crypto wallet. So it's like a banking account, You just install, for example, B2B and Pay, pass the KYC, all that stuff, and then you just can accept crypto, store it with your wallet, and then send, your wallet address to your customers, and then they will credit funds there. So it's more like banking account, but it's a little bit less complicated stuff. So, and finally, because I believe I don't have much time, I will tell you about ourselves. So, as of now, we are full-scale ecosystem for corporate market players. We facilitate a lot of services, including providing like technology, some, high-caliber tech like liquidity hubs, money management platforms, white label of trading platforms. Of course, we have our own crypto processing regulated in a couple of countries, and we're acquiring more licenses. Our digital banking services and venture funds, which mostly invest in some projects which are close to our heart and to our ecosystem. So please subscribe to our YouTube channel, to our Telegram channel, watch for the news, and thank you. So if you have any questions, I'm more than happy to answer. Yeah. Which slide? Here? Email checks. Well, I try to explain that. Basically, look, one of the major concerns of regulators or financial intelligence units, whether you can't really look into the crypto, you can't understand the source of the funds, whether it's clean funds. So now all the regulated crypto processing implemented QIT, which is know your transaction in KYC system. So it's like with bank. Once you become our, well, not exactly our, but client of any crypto processing company, so you will provide all your documents, your shareholder details, your directors, everything, your business model, and every transactions will be checked, whether it's a clean transaction or not, whether it's has any economical sense or not, like the same with bank. Yeah, it's against money laundering, of course. Okay, thank you. Please. Of course, let me do it once again. Look, you can be sure about centralized regulated stablecoins, USDC. Because basically there you belong on the solvency of the concrete New York bank. But it's the same, if, for example, just imagine tomorrow Goldman Sachs will go bankrupt. It's a systematical risk. So the same is here. It's as protected as the best banks. Regarding USDT and non-regulated stablecoins, well, of course it's more risky. But still, first one and second one can be used like freely.
I have. No, what's wrong with it? Okay, I have a question in regards to the regulated, centralized cryptocurrencies. So I don't know how you can, like, if they are regulated, are they being going under a certain rule, like the central bank of any country, that on the basis of your company, or like, for example, you don't know where they're exactly coming from because they will go through a blockchain. So how can you really track these transactions, or how can you know that these transactions or this amount of money that is going to a wallet is not going for something that is going to harm someone, or like illegal things?
Of course, of course. Look, let's take USDC as an example. So, in order to do such easy in the state of New York, you need to first acquire local licenses, and also you need to pass the audit. So, for USDC, it's conducted by Grant Thornton. So, you just can't issue more stable coins than you have assets backed that stable coins. So, yes, we can tell that they are regulated because the company which is issuer of USDC is regulated within the state of New York. And second, regarding, like, you just can't issue more stable coins than it is permitted first in your, like, white paper, and second, which you have assets in the banking account.